Now, I have not seen this in a long time. Tesla stock looks ready for a much larger breakout. But what I'm actually referring to is the aggressive short covering that we've seen today. Millions and millions and millions of shares, no exaggeration, were actually covered on today. And this hasn't happened for a very long time. And what this signifies is exciting. It means Tesla stock is probably going quite a bit higher in the near term. And I will explain that here in this video, but I will also give you a little bit of caution over the medium term. Because it's not all going to be peaches and rainbows forever. Not at least with what I am seeing and what I'm going to report to you here in this video. Now, just to make sure we're all caught up to speed with what happened to Tesla stock today and why Tesla stock did so well relative to the broader markets, I will share with you the news that I shared in the video that came out earlier that is causing Tesla to do this well. Now, a lot of people, missed this news today. Nobody really reported on this news, but it's massive, okay? Now, as I said in the last video, there is hope of a larger stimulus plan for China. Now, the PBOC also cuts rates. They did that last night. And they are preparing a rare briefing that's going to happen tomorrow, which will technically be like overnight tonight, early morning hours tonight. So really over the next 12 hours or so, 18 hours or so, you could have greater stimulus measures over in China, with some saying that you could get cuts to all different kinds of rates. You could get a cut to the RRR rate, the MLF cut, rate cut, and a mortgage rate cut that is probably coming with this rare conference that is going to take place in China, again, within the coming hours. Now, why is this impactful for Tesla? Well, historically, again, the US has been Tesla's most important market, but over the past couple of quarters, China has actually been delivering more vehicles than the US. Now, China on a quarter-over-quarter basis is showing about 20% growth from Q2 to Q3, at least via the numbers we're tracking so far. And we're only up about 2% year over year. Year to date, right? 37 weeks into 2023 versus 37 weeks into 2024. Now, this is all at the same time China is basically collapsing. It's actually incredible. Tesla is showing the kind of strength they are in China. Whereas if things get better from here in China, then Tesla may be able to do better, and that'll obviously be good for Tesla stock and what could now be Tesla's most important market. So Tesla's like a dual, US and China stock. It has very high exposure to what happens in China as well as what happens in the US. So that was the big news that came out today. We don't know with certainty what that's going to do, but it did drop basically treasury yields over in China, and that right now is having a positive impact to Tesla because Tesla's buying down the interest rate over in China, offering low interest rates. Now they're buying down less interest rate, and that is boosting Tesla's profitability in real time. So that was the big news from the day today. But the reaction that you've seen in Tesla stock, with Tesla rising almost 5%, and the amount of shorts covering is really something we have not seen in a long time. So let me just give you some generalized numbers here. You have 2.87% short interest of free float, $18.99 billion currently sold short in Tesla stock, totaling 79.73 million shares that are sold short. But take a look here. You have return shares of 7.58 million and borrowed shares of 2.31 million. So yes, there's quite a bit of borrowing as well happening today, but the amount of shares being returned, I have not seen in a long time. Even during this rally with Tesla, you did not see that many shares be covered on any single day. Okay, so this is pretty unique in that sense, that there's 7 million plus shares actually being covered on today. So on net, you have about 5.3 million shares that are being covered on. As I said in one of the prior videos, the Tesla short squeeze has officially started. I said this a couple of days ago, maybe a week or so ago. It was right after the Fed, so maybe not quite a week ago. This is furthermore validating just that. Tesla stock closing above $246 per share is the next leg of that validation, which also happened today. As I have had drawn on this chart for now the last couple of videos, you had this gap to fill at about 246. Getting above that level really just took out your level of resistance. From this point forward, we really don't have much resistance. You could say around 270 is going to be a resistance level because that's where we essentially peaked out last time. This was in July of this year, of 2024. So at least until we get to that level, there's really not much, if any, resistance at these prices. And you're getting back to that 250 level, which I think psychologically is a big, if you will, let's reduce exposure to the short in Tesla stock from a lot of big money, right? Above 250, I don't think big money wants to be short on Tesla anymore. Not with the Robotax event on October 10th and the sugar high that seems to be, running rampant in our markets. Like, people are not fearful over the Fed's 50 basis point cut. If anything, it's just igniting the bull thesis for a lot of investors. But that's my warning, that even though Tesla could do very well in the near term, heading into October 10th, it wouldn't surprise me if Tesla's a $300+ stock. You do want to be a little careful though, okay? Because historically, when the Fed cuts rates, that's when you actually want to be, maybe not panicking, but very defensive, okay? Usually when the Fed is raising rates, that's because the economy is good. And usually as a byproduct of that, the stock market is good, right? As the Fed cuts rates, it's a sign the economy is not doing as good. And as a byproduct, markets do not tend to do as good. So with this cut that we've seen of 50 basis points, a double rate cut that is, it's a sign the economy is not doing as great. Now, what's different about this time around is you've actually seen the unemployment rate going up for over a year now. Yes, it's been slow, it's been steady, but you've been seeing this for over a year now. Whereas in other cycles, the unemployment rate just kind of spiked, right? Within, a couple month period, the unemployment rate just took off higher and we were in a recession once the Fed starts to cut rates. This time it's been a more slow and steady process. And I think that's why, or I think that's because the Fed has really done a lot of easing over the past couple of years. The balance sheet exploded, the government spent a bunch of money, and that kind of delayed the inevitable. I think what's going on over in China is really just because they didn't spend as much as we did. I think we're ultimately heading in the same direction, but China didn't spend as much as we did. They didn't get the high inflation. We spent a lot more, we got the high inflation. But I think we're ultimately heading down the same path as China is going down as we speak. And I think just from this simple, image here, I recommend you save this or go follow the X account over there. It's Michael Tyler, and you can see this a lot, probably a lot clearer than what you can see in this video. This is usually the time you don't want to be all in. You want to be a little defensive. But again, what happened when the Fed cut rates September 18, 2007 is stocks actually went up following that. Stocks did well following that cut. And it wouldn't surprise me if stocks do well after this cut. And that's exactly what's happening this time around. There is some historical precedence of that. But the bottom line is, when the Fed starts to cut, especially with 50 basis points, there's a problem. And you want to be on the lookout for that problem to, show itself to investors. And when it does, that's when you start to get pretty dramatic downside for equities. I think, again, just further validating kind of this lagged, this inevitable, China-like slowdown that we are going to see is also the job openings. Now, yes, job openings surged as the economy did well, but they've been falling now since March of 2022. Okay, and what you tend to see during a good economy is more and more job openings. They tend to just go higher and then they plateau and then they start to fall and then you go into a recession. That's why a lot of people thought in 2019 when the Fed cut rates the last time on August 1st, it was only a 25 basis point cut, but a lot of people at the time thought we were heading into a recession because job openings had plateaued at about 7.5 million, 7.6 million, and then by January of 2020 we were at about 7.2 million. So you had lost about 400,000 job openings. And you'd started to see that typical kind of pre-recession job opening slowdown. Well, now you've been seeing that for a while, and the clear trend is lower for job openings. And as job openings do go lower, this will start to raise the unemployment rate. And one of the last things I want to share with you is the amount of active home listings. Now, in February, March of 2022, you were at about 350,000 homes that were listed out there on the markets. Today, you're at 909,000. There's essentially 3 times more homes listed today than there was in March of 2022, over 2 years ago. This in and of itself is not a huge problem. But as rates have started to move lower for mortgages, purchase agreements or purchase index weekly mortgage applications have not done anything. They've continued to fall. So you're getting more supply with less demand. More supply with less demand, well, we all know what that means. That means prices will go down. That's a massive problem, right? That's it's not a good problem to have. And in fact, we're at the lowest level of mortgage applications in recent history. Since going back to 1991, we haven't been this low. And with the, amount of homes starting to skyrocket that are out there on the markets, I mean, just let's look at that from a simple Econ 101 standpoint. Again, that means prices fall. More supply. 3 times more supply, much less demand. That's a problem. I mean, this index was at 312 points in January of 2022. In March of 2022, this thing was at 265 points. Today, it's at 130 points. It's down 50% from where it was in 2022. Yet housing supply is up 300% from where it was in 2022. Doesn't take a genius to figure out this could start negatively affecting home prices as more homes get listed on the markets and as people really just stop buying homes. And that is where we are at right now. Now, if home prices start to decline, then we're looking at a much larger problem. That could be the tipping point to push this economy into a much darker situation. And I don't know when that'll happen. Home prices usually slump if they're going to slump over the winter time. And, you're heading into colder wintertime weather now. It's possible that this winter could start to reflect home prices falling, could start to reflect slower consumer spending patterns. But I think by the spring, it's going to become pretty damn obvious that economy's weakening, housing market's weakening, labor market's weakening. And for the markets to expect 15% EPS growth for the S&P 500 next year, you can't have that. That doesn't support almost 20% EPS growth year over year. And that's where the big problem comes in. It's not necessarily a problem if we head into a recession or not. Like, if markets are priced for a recession like you were in 2022, no big deal. Stocks can start to go higher, right? But when you're as high as we are today, and when you're not pricing in any risk to the economy slowing down or recession, that's where you could be looking at big downside here over the next 6 months or so, because we're not pricing in those risks. And eventually it's going to slap markets in the face. Seriously. One day we're going to wake up and the sentiment is totally going to shift. Whether that is the Fed finally becoming honest with markets, whether that is a really bad GDP report, really bad personal spending report, consumers consumption report, something will start to cause this flip. And when it happens, it's going to happen fast, because of the valuations that we are at. Could be earnings season as well. I am not too optimistic about Q3 earnings season. Should also put that in there. So I think inevitably Tesla stock will come back down, probably under $200 per share. But in the near term, I think there is quite an advantageous upside potential here for Tesla that could stretch Tesla well into the 300s, potentially as high as 320 or so, heading into the Robotax event on October 10th. I do expect an election correction that could be 7 to 9%. But you know, what happens after that, I think, is a little bit more important. After the election is when I think data might start to come in a little bit better. I think by then we're going to be, 2 months, 3 months past the first cut. We're going to have another cut coming, November 7th. I think that's the time in which I'm going to be on real cautious mode, I guess, if that's the terminology I can use, for more aggressive downside in our markets. I'm not really concerned about an election correction. Yeah, there could be a good trading opportunity there. If you guys want to trade with us, check out that link down below in the description of this video. But as far as the big downside, the time to put a lot of money to work, I really think that's between November and March of 2025. Could that extend into April or May of 2025? It could, but I think that 5-month stretch, again, between November, December, January, February, March of 2025 is when we're going to get that larger buying opportunity, which could be 20, 30%. If we go into recession, if it's starting to look really bad, then it could be 40+%. Those are the kind of numbers that I'm looking at here. And Wall Street, they're lying to you. The Fed's lying to you. The government, that data is as unreliable as licking your finger and you know, putting it up in the air and seeing which direction the wind's blowing and then flipping a coin, right? It's not accurate at all. I think corporate earnings are going to be the most accurate thing because they will, again, go to prison if they lie to you and get caught lying to you. So I think that's going to be the best area to look for to get a more accurate assessment of what's going on in the economy. So yeah, these are just some of my thoughts. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.